Friends, how are you? This is Igor Pechkovskyi with Windermere Bellevue Commons, your trusted real estate advisor on the east side and Seattle, Bellevue areas. Gosh, I had so much coffee. We have such a great video for you today. Today, we're going to be talking about the shifting market. I heard the word shifting for like 15 times this week alone from everywhere you look. The market is shifting. What's going to happen? Interest rates are at 6%. We're going to die. Let's keep calm. I'm here to bring some clarity and explain to you what's most likely going to happen. I have really good data provided to us by our chief economist, Matthew Gardner, and I just want to show you a few things. So get some popcorn, enjoy. It's going to be a great video. Here we go. Let's get going. So first things first, let me start with this. First of all, we are at 6% conventional high balance interest rates, all right? I want you to go back and find two videos. One, first of all, market update of the previous video that I make, where the numbers were for the last months in Bellevue and the east side. Because the next video that I'm gonna make will be about the upcoming numbers of where this month's is. And two, I want you to find the video that I made on interest rates alone. So in that one, we dive into the history of interest rates and inflation and what usually happens. So I'd say pause this one, go check out the interest rate video and come back. So we're gonna discuss this in a little greater detail. So let's look at our market over the last, 32 years, I think. Here's what it looked like. What got a lot of people concerned is a fast growing home price. As you could see on this slide, since 1990 all the way until right about 2007, the market went up at 142%. And that translates to 5.6% over these years annual rate. Then right around 2007, you could see the market took a dip for a good correction, 33% over the matter of 4 years. And then since 2012, it shot out to 2022, 131%, very, very fast. And people got concerned that the appreciation rate of 8.6% is quite fast on an annual basis. So if really high at the speed of light rising home prices were mostly a big complaint to many buyers that would continue to buy, the concern was the increased interest rates. As you could see in the slide, since the beginning of 2022, end of December, interest rates were right at around 3% to where they are right now. And this is 5% based on April 14th. The reality is interest rates are closer to 6%. That what got everybody concerned. How fast did they go up, right? The reality is they should have increased interest rates over the last year, 2021, and have gradual increases, but they waited until the point of inflation kicking butt so hard that they just increased it in a matter of 3-4 months. We were 3%, now we're at 6%. And the first thing that everybody has, it's like, well, what went up must definitely come down, right? Because that's just the way it works. But does it? So when my clients reach out to me with those thoughts like, hey, prices will go down, I usually would explain to them why I think it'd be very unlikely. And I mean, there is so much money around to start with, and I'll tell you a little bit more on that later. But I finally got a slide that explains what happened over the last 7 interest rates increases, because it's not like it's happening for the first time. When I started my career in 2017, the interest rate was at 5%. And then it went down to 2.75, and now it's back at 6. So let's look at this slide. As you could see here, you have a start date and an end date. But first of all, I want to start with duration. So you have different 7 points, back in the day, 93, 96, 98, 2003, 2005, 12, and 17, when interest rates went up to beat inflation. And usually they would go up on the average duration of 13 months. So let's say that right now it's a month 1, right? We're in end of April, almost May. Interest rates going to go up. They're already at 6%. In about a year and a half on average, historically, if history repeats itself, it will, they will go down again. But let's go back to our slide. So the mortgage rate 1993 increased to 9.2%. I know that us millennials, we always like, my rates should be 2.5. Well, hey, it used to be 9 and it used to be even higher prior 90s. So let's relax here. So 7 to 8.2 in 96. And as you can see, June 2005, interest rates went to 6.8% and then 3.4 to 4.5. September 2017, interest rates were at 5%. That's exactly what I'm saying. That's when I personally started my career. So the average mortgage rate increase will be 1.4%. This time they did it drastically, 3 till 6, which got people concerned. But the reality is the house prices over this time would continue to appreciate. I'm sorry. But 5.2% on average in the United States, average appreciation. And that's where it should be. The purpose of increased interest rates, as I'm repeating myself, they should have increased them over the last year, not just in the matter of 3 months. The purpose of it is to slow down and beat inflation. Going up 30% year over year is not okay. Like appreciation of 35% in Bellevue year over year is not normal. We should have an appreciation of 5-6%. That's normal. Of 8%, let's make it 10, but not 30. So that's what it does. The home prices would change on the average rate of 5.2% with the higher interest rates. And that's where we most likely going to see. But what is going to change is the volume of sales. So most likely with this 6% interest rate, obviously a lot of people not going to be able to qualify and buy, and the volume of purchase will drop, which as you can see it over the years on average of 5.6%. That's what is going to happen if the history repeats itself. I know it's a lot to take in, but also just the last thing that I'm like, what is housing starts? Housing starts, it's another thing where the new construction starts, right? So there will be less new construction because usually when builders look at it and they look at the higher interest rates, I work with builders. So you have interest rates just kills the higher end of the market. It becomes harder to sell $3 million homes, but you still have inflation. So the cost of labor and everything is rising and their profit margin is being really squeezed. So usually there is less volume of new construction homes and through the history by 10%. That's what housing starts is. But if the history repeats itself, we still, especially in our area, most likely going to see prices to appreciate. It's very likely that they would drop, but they shouldn't be appreciating 30% year over year, but rather 5, 6, 7, 8%, where the amount of sales would change probably drastically. And why? Let's even talk about first-time home buyers, which is a 30% of our market. It's a very large demographic. They're probably most likely are the first ones to get hit the most because at 6% interest rate, they're just not going to be qualified to purchase homes at the prices that we have already. So you might disagree with me and you say the prices will change and we'll see. I'd be only happy to if it drops a little bit. But the reality is that those were national numbers. If you come back to Seattle, there is no inventory, guys. Remember, housing in Washington, in Seattle and Bellevue will never be affordable. For the reason is our topography, our geography. We have no land. Last weekend I've been in Vegas. They have a lot of land. There is a lot of new construction. You can build anywhere. Like I went the first time ever, I stayed outside of the Strip and just residential market, build anywhere. And they are building. So you can really keep on adding inventory as long as you can find water, of course. But there is no such thing in Bellevue. It's all hills, it's all mud, it's all lakes, it's all mountains. It's all very restrictive. It's very complicated, very expensive to build. And we live in a democratic state. To get a permit, to get an approval for something is extremely difficult. So there will never be enough new inventory to satisfy the demand is just what I believe because I work in this field, right? And on another side, you have so much demand, so many people making a lot of money that they can just afford it. So most likely what we're gonna see is the volume of sales that will decrease and appreciation going back to normal based on this increased interest rate. And here's a bonus thought for you before you go. So one more thing I want before you go. Housing is a hedge of inflation. It always had been, almost always. Look at the slide. 1969 all the way until 2021, housing change in median home price is the blue one, and average annual inflation is the gray one. All the years, housing is way above the inflation. Of course, in 2008, the reason the market had dropped back then, we were in a mortgage fraud environment, which doesn't exist today. I talked about it for a long time, different credit, different incomes, verification, everything. But besides those years, housing just beats inflation. Here's a few points for you to think about. I'll let you read it, you can pause it. But the bottom line is, when you have inflation, you can lock your interest rate when you buy a house for 30 years or for 15 years. It's fixed. Whatever your payment will be, it's fixed no matter what the inflation does. So when inflation environment, when you start making more money and incomes goes up, it actually, your payment technically, becomes more affordable or cheaper. So at any way I look at it, if you can afford it, I'd buy it. You could lock the price and refinance year and a half on average, as we've seen on previous slides, or 2 years later, because sooner or later the rates will go down. We do need to get a grip on this inflation. They should have done it sooner than in just 3 months. But if you can afford it, I'm buying. My advice would be to buy if you can, to find a good deal, lock the price, refinance two years later to beat inflation. Friends, to summarize, I'll tell you once again what I tell my clients. One, don't be worried. We'll be fine. So prices will be just fine. I truly believe so. They're not going anywhere. They kind of relatively will stay the same, maybe change a little bit. Two, inventory will be low. There is no way we're gonna have more inventory over time. When you work with builders, when you go to city councils, when you see all the stuff they ask you to do, we're not gonna have more inventory. We're not gonna have more affordable housing in Bellevue. There is no way. Three, the sales volume will change. Most likely it will change. We'll see less sales, less listings, less buyers would be able to afford. So the sales count would decrease most likely. Four, rates most likely will go down just the same way as they went up. Because when the reality is, when things are really good, we should have higher interest rates. The rates go down when things are not so good. So over time, we're gonna get our rates back to normal. So if you can afford it, if you can buy it, don't poop your pants, things will be fine. Just get out there and buy whatever you wanna buy. If you need help, reach out. This was Igor Pechkovskyi, your trusted advisor on real estate in Seattle and the East Side. And see you next month with a new video. Talk to you soon. Bye-bye.